Hey there, welcome to the webinar. I'm Scott Welsh, and today we're going to talk about a famous old trading method that made a ton of money several decades ago. We're going to apply it to a bunch of markets and see if it's still viable today. But before we get into it, of course, here is your disclaimer. Past performance does not guarantee future results. Of course, please do not risk any money that you cannot afford to lose. And keep in mind that I will be showing some numbers today, but these are not live results. These are just hypothetical numbers to give us an idea of what might be possible. All right? All right, let's get into it. Now, I love looking at old strategies. Anything that's made a bunch of money in the past, I'm absolutely interested in if I can still use it today, and perhaps you're the same way. The famous old strategy that I'm speaking on today is the turtle trading method. Well, what's that? Well, back in the 1980s, Richard Dennis was a famous futures trader, and reportedly he made $100 million trading his methods in the futures markets, which is an incredible amount of money then, and it's even more incredible thinking of it in today's dollars. But he had a friend and partner named William Eckhart, and they had a big argument over whether traders are born or could be made. And they couldn't decide. They couldn't argue the other one off his position. So they did an experiment. They wanted to prove whether or not you could take literally anyone off the street, teach them a trading method, and them then go on and be successful. Kind of interesting, right? That kind of applies to us. Could we, as normal people, learn a trading method and go on to make millions, right? It's worthwhile thinking about. So back in the 80s, they sent out open invitations in the newspaper, and oh, I yearn for the days of newspapers. But they sent out an open invitation. They got a bunch of responses, although not as many as you might think. You'd think everybody would love it, but a lot of people thought it was a hoax, so they didn't get as many as they thought. But they got them from all walks of life, and eventually, through an interview process, ended up whittling it down to just a handful, about a dozen or so. Once those final traders were chosen, and they called them the Turtles, that was just a nickname they gave them, they trained these turtles for only 2 weeks. It's pretty amazing, right? They were going to give them millions of dollars of their own money to trade and just train them for 2 weeks. Clearly, this was not that complicated, especially since these people did not come from a trading background. Like, trading was not necessary. They just had to believe it could be done, and Eckhart and Dennis had to believe that they would be successful in implementing the rules that they gave them. So we're going to talk about these rules and see if we can implement them and make money like the turtles. Okay? But then, yes, they literally gave them millions of dollars of their own money and set them free out into the markets. How did it go? Well, not surprisingly, if we're talking about it, the Turtles reportedly made $175 million of profits, which is amazing in just 5 years. I mean, it's amazing, period. Right? It's just incredible. Now, those numbers aren't exact because the Turtles were very secretive about their experiment, but if you look around, that number is probably pretty accurate. And in any regard, it was a ton of money. Well, that's great. It's a great story. Regular people, given some rules, they made millions. Wow. Let's get a part of that, right? Of course, do these rules and methods still work today? Because it doesn't help us if they don't work. All right, what was the strategy? Well, Richard Dennis was a trend follower. What does that mean? That means he believed that the markets were not efficient. He believed that markets trended. People get emotional, people get scared, people get greedy, and prices of financial instruments, for him it was futures, but any financial instrument, when things get crazy and emotional, it goes way, way up, 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 or it goes down, 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 down. Trends happen. And furthermore, huge trends happen. And if you are a trend follower, you believe this with all of your heart forever, and you decide and commit your trading life to just being a part of those trends. They exist, be a part of them, and ride them for as long as you can. However, we don't know when the next trend is going to come, and we don't know how extreme it's going to be. Doesn't matter. If you are a trend follower, you have to be there at every possible opportunity, because we just never know. Now, if we have to be there every single time, not all of those are going to be winning trades, right? So trend followers generally don't win a lot. Their winning percentages are 10, 20, 30, 40%. Not great. But the winners in certain times are monstrous. One trade can pay for a whole year of losses and then some, and then a whole lot more. Maybe one trade can even pay for 2 years, or maybe pay for the rest of your life. The bottom line is they wanted to be there because this happens, and if we ride it long enough, we will make a ton of money long term. Now, there's a bunch of research out there. Nothing has been as researched as trend following, and I've talked about it in blogs and podcasts and every other place that you can talk about it. The bottom line is this: research shows that a trend following method outperforms an index by about 3 to 1. And this is over hundreds of years, right? Richard Dennis didn't reinvent the wheel. He just used a philosophy that's been around a while, and it's worked for a long, long while. Again, you can do some research if you want. I'm just telling you the research that I've found. Now, all that being said, the Turtles did this in the 1980s. The markets were way different. There were no computers to do trading. Everything was done by hand. That was not anywhere close, not even remotely close to the environment that you and I trade in now. So again, does the turtle method still work? Well, we have reason to be optimistic, and here's why. There are still original members of that turtle class still trading today. The turtle experiment ended after just a few years. And some of these guys are like, well, I don't want to stop. I just made a ton of money. So they started their own firms with the profits that they were a part of in the turtle experiment, right? They got to keep some of the profits that they made for their creators. So there are still people going strong right now, trading hundreds of millions of dollars. Original turtles, they're still out there now. Maybe there's something to it, right? And if you read the interviews of these original turtles, Eckhart, for example, is one of them, right? The original turtle creator, one of the founders, is still out there running a fund, by the way. But they will say that their methods really haven't changed that much over the decades, which is kind of cool, right? Second, even though they traded in the 80s, an original turtle did come out about 10, 11 years ago, whatever, in 2007, and said that original turtle rules, not changing a thing. In 2007, $10,000 would have turned into $25,000 by the end of the year, which is pretty phenomenal, right? That's not today. That's several years ago from when I talk to you right now, but it was also decades after the 1980s. So again, we have these clues that the turtle methods might still work. But those are just anecdotal, right? We have to find out for ourselves. So I put the original turtle rules on a few different instruments, and let's find out how they did, shall we? Well, let's not exactly find out yet. Let's talk about the rules, right? I mean, you do care about the rules? Maybe you do? Probably you do. If you Google original turtle rules, you will get exactly what the original turtles did. It's a PDF. It comes right up. Click on it, and you've got it. It's 100% free. There's the link right there on the screen, metastocktools.com, blah, blah, blah. Right? Just Google it, and it will come up, and you can have everything right there in front of you and go ahead and implement it. You don't need a robot or trading software to do it. You can do it manually. They did it manually. But it's just be right there at your fingertips. But if you don't want to do that, or if you just like to listen to the rest of the webinar first, I appreciate that. Then here's a summary of the turtle rules, okay? They were trend followers, and the way they followed the trend was on breakouts. They felt, or Dennis felt, Eckhart felt, that when price breaks out above, if you're going long, if it breaks out above the high of the past 20 bars, or in their case 20 days, because the turtles used daily charts, if the high right now is breaking above the high of the past 20 days, something is up. This might be it. This might be a new trend, and they wanted to be a part of it. So if it broke the high of the past 20 bars, They got in. One tick above, boom, they're in. Same thing. They went both long and short with the exact same rules. If price broke down below the low of the past 20 bars, past 20 days, boom, they were in again. Now, what you might think or realize if you've tested this at all or traded it at all, a 20-day breakout is pretty, well, I don't want to say premature, but it's pretty quick, right? Just one news event makes the price go above the high of the last 20 trading days, about a month. One news event might say, okay, it's going up, and then no, it's not really going up, right? You're not taking a long, very long period of time into consideration on a 20-bar breakout. It might be a false breakout. Yes, you might catch that trend. Of course you will, right? If you're there every time, one of those is going to be a big trend. But it might subject you to a bunch of false breakouts and a bunch of stopouts. So keep that in mind if you're thinking about the turtle method, because they also used a 55-day breakout. They waited longer in some cases. Let the noise of a 20-day breakout, no, I'm not just going to ignore that. I'm going to let that be ignored and only focus on a breakout of the past 55 bars. That is more substantial over a long period of time. Yes, you might miss a chunk of the breakout, but you're going to get much less false breakouts, right? It just makes sense. The longer you wait to get in, the more it has to quote unquote prove itself, the less false breakouts you're going to get. That's just common sense. But you will lose a chunk of that trend, because if it gets out of 20 and gets going for a while, you won't pick it up until the 55-day mark. Keep that in mind. That's something to consider. The turtles did both, and sometimes they did them in the same trade. They take a breakout above the 20-day high and then take another entry at the 55-day high. Or sometimes they just picked one or the other, right? As you'll see, I believe in the 55-day breakout for traders doing it today, but you can research either one. Then they had a hard stop. If it's not going to break out, they want to do get out immediately. And they believed in volatility. So they didn't just say, well, it's X amount of points. They wanted to use the average true range, the ATR. So they said, if price is going to break out, it should break out. It should not break out and then retreat back down and then break out again. Like, they didn't care about that. To them, if it moved twice the amount of the average true range, if it broke out and then went twice as much as it's been averaging over the past number of bars, the trend was not going to work and they wanted out. So they simply took the average true range of that instrument, multiplied it by 2 to give it a little room, just to give it a little room, and if price went the opposite direction of ATR times 2, they were out, no questions asked. They also added to positions incrementally as price went in their favor. I did not do that for our webinar today. 2 reasons. I wanted to keep it simple because I love simple, and simple is easier to learn for you, but also because I've done a ton of research on the turtle methods and adding to positions, and my research has shown that it's not more profitable. It's just not. It's about the same or slightly worse. And I've tested a bunch of different instruments. Please do your own research. Don't take my word for it. But for today's webinar's purposes, I did not add to positions, okay? I took one position on one breakout and just rode it until it was profitable or it stopped out, okay? And when things went well in their favor, the turtles used a 10-day or a 10-bar trailing stop. So if everything is going in our directions, we had our bar breakout and everything's going perfectly, well, when do we get out? Well, we ride it as long as possible. Well, how do we know when the trend ends? The trend ends to the turtles when it comes back down for a long trade, when it comes back against us below the low of the past 10 bars or the past 10 days on a daily chart. If it broke the low of the past 10 bars, that's enough. We're done. Now, for a 20-day breakout, they used a trailing stop of the past 10 if it breaks the low of the past 10. For a 55-day breakout, they gave it more room, and they used a 20-day, 20-bar trailing exit. So if they used a 55, they didn't get out until price had reversed below the low for a long trade, below the low of the past 20 bars. Okay, 20-day breakout, 10-day trailing exit, 55-day breakout, 20-day exit, right? Those are the two different parameters they used. And lastly, they only risked a fixed percentage for each trade, and that was it, not negotiable. They used 1 or 2% maximum loss on each trade. I'm going to use a little bit more than that because I'm not trading a portfolio. I'm just trading one thing. If you're trading a bunch of instruments, keep that risk under control, right? If you risk 10% a trade and trade 10 instruments, 10 times 10, that could be 100% of your account if they're correlated or they all go against you, okay? So you can use a little bit more risk per trade if you're just trading one or two things, but keep in mind that the turtles only used 1 or 2% for each trade. Got it? All right, those are the rules. Again, look them up if you want to. Let's take a look at some results and we'll look at some charts. Here is the euro dollar. I wanted to apply turtle to a bunch of different things, not just the futures markets that they used. So here is Forex euro dollar daily chart. This is from 2007. Data, hypothetical data to 2018. You can see that the total profits here were about 13,000. The maximum drawdown, peak to valley, was minus 4,900. This was a hypothetical $10,000 account. Profit factor was great. The drawdown close to close, not taking any sort of close to close plus a little bit of drawdown on the next trade, right? Max drawdown, peak to valley adds everything, right? You lose a trade, and then the next trade you get in, that goes down too before it eventually works out. So that is the worst you'll ever see your account. I find this to be a little more realistic in real time, but for my risk management, I use this number. But, really from close to close, it only lost 2,600. If you add up all the trades at the end of the day, the max drawdown was 2,600. Hope that's clear. Let's just use this number because this is the worst it ever did at any given period, okay? Let's go to the charts real quick. Here's the euro dollar. Make it a little bit bigger for us to look at. All right, and here are all the rules that we talked about. You can see on the screen. Now, I built a robot. This is absolutely tradable by discretionary methods or by manual trading. I built a robot. I have software that can do it for me because I like robots, okay? So this is the robot taking these trades. A cyan line is a positive trade, and a red line is a negative stop out. All right, as you can see, this was a bunch of consolidation or even some downward momentum. It comes back up. When price goes above a previous high, boom, it's in. And you can see that you ride it up and down. You do not care. You're trying to milk every last penny out of this until you can see it broke the low of a certain number of bars and it got out. Okay? That's an example of what trend followers do. Here's an example here. Price broke below a bunch of bars or the low of a bunch of bars, and then it reversed and up. They used ATR, multiplied it by 2, and it just was a hard stop. It never really even went in our direction. All right, let's take a look at the actual parameters, though. You talk about long or short, right? This goes both directions, as I mentioned. You can see there's our 55-day breakout, just like we talked about. The trailing stop was 20, so the low or the high of the past 20 bars. I risked 4% per trade, so just keep that in the back of your mind, which is $400, right, on a $10,000 account. Nothing else. There's the ATR. Use the ATR of 20, and I multiplied it by 2, just like we talked about, okay? I built in profit exits. Nope, didn't use them. I built in a time exit. Nope, didn't use them, right? We're just using original turtle rules. As I said, it's a hypothetical $10,000 account, and you can see that it just risked 4% per trade, right? So this is exactly what we talked about, and there's an example of a trade right now, and I am actually in this trade in my own account. We can talk about that at the end if you like, but you can see that price broke below the low of the past 55 bars recently in April 2018, and it went in our direction for a long way. Price is reversing, but you can see our trailing stop is way up here according to original turtle rules, so we are not anywhere near getting out of this trade. So hopefully if you want to stay in profit, you would root for it to continue to go down, right? There's an example of the turtle method, and that's the profit. And we'll talk about those numbers again in a second. But I also put it on a futures contract because, the turtles traded futures. So let's go back to our trade station, and let's get ES up on the screen. This was a massive winner, and that's fun to look at, right? Look at it broke above the high. of the previous number of bars, right? It consolidated. Boom, we got in. And this one went crazy. The E-mini just went nutty. And then there was that big reversal in 2018 around February, and it plummeted. Once it finally broke the low of the past 20 bars, you got out, and that was a massive winning trade, right? That is what trend followers live for. Take a quick look just to confirm all the settings. Now, this is important, and this is up for discussion, and it's something that you need to consider. I only went long in this particular instrument. Remember, the euro dollar went both directions. This is the E-mini S&P 500. This is a stock-based instrument. Stocks have a long side bias. Yes, of course you can short stocks, right? But I did not because of the long side bias. And when you run your own tests, you will find if you use these rules, short trades on the whole are negative. They do not help the bottom line. They are flat out negative. Going long only, profit. Going short, negative. So what would you do, right? Now, if it makes you uncomfortable not to go both directions, that's fine. I'm just telling you, for this strategy, because it was stock-based, I only went long. That is something that you would need to decide. And you can see the rules are the same. The breakout was the 55-day breakout with the 20-day trailing stop. Again, I'm risking 4% per trade on a hypothetical $10,000 account, and there's your 4%. Same thing, ATR of 20, I multiplied it by 2. So you can see that that is what we used. And if we go back now to our slides, profit was 22,000, which is pretty nice. The drawdown, though, max drawdown intraday peak to valley was more. You can see it was a $15,000 drawdown. We only traded one contract. If we go back to here, we can see that we only, in Forex, we averaged about 4 mini lots per trade, right? We didn't trade even full lots. All we did, though, is risk 4% on each trade, and the robot naturally adjusted the size each time so that the maximum we could lose was 400 bucks. So this actually varied, and so did the turtles. Your trade size, remember, we're using ATR multiplying by 2, and whatever that number is, then we have to size it so that we only lose 4%, or in the turtles' case, 2%. Sorry if that's too much math, but you can just roughly say you used about 0.4 lots on each trade. For ES, though, we used one contract every single time. We did not change it. So more profit, but also more drawdown. And then I applied it to one more market, Netflix, just an individual stock. So we did Forex, we did futures, and we did a stock. Why'd I pick Netflix? I'm not sure. I like to look at Netflix, Apple, Amazon. Those are the ones I like to look at, especially for trending sort of things. So I just picked it. I didn't really cherry pick it per se, but I wanted a stock that I feel like is going to be around for a while that trended and just took a look at it. So as you can see, if you do find a trending stock, right, you need horses for courses, as they say, right? You need to pick stuff that fits your method. Netflix apparently is one of those things that fits the method. Profit was 20,000. Max drawdown was great, actually less than our euro dollar, only 4,100 max drawdown. Profit factor was great. Return were good. Average winning trade looks nice, right? It looks pretty good overall. Let's go to the chart. I'll minimize that, and let's get Netflix up on the board. Again, this was a stock, so I only went long. You can choose to go short if you want. But guess what? Going short was negative over the long term. Okay? Let's take a look at the settings once again. No surprises here. I turned short trading off. So on Netflix, it was only going long. 55-day breakout. Exit on the low of the past 20 bars. I risked 4% per trade, 400 bucks per trade. Same ATR, hypothetical $10,000 account. Got it? And if we go back once again to remind you, $20,000 of profit, only $4,000 of drawdown. Now, let's sum that up on the screen here. The euro dollar, right, made 13,049 max drawdown, 4,900 max drawdown. The ES, more profit, but had a much bigger drawdown. But still, I would consider that a success, right? These are turtle methods that are several decades old. And then I put it on an individual stock also, and that made $20,000 of profit with only a 41. So it was the most profit and the least amount of drawdown, which is interesting, right? Now, what does all that mean? Is that worthwhile? Well, here's what the stock market did in the exact same time period from 2007 to 2018. The market, if you used a hypothetical $10,000 account, apples to apples, the market only made $9,600 of profits and had a 5,000 plus drawdown. So you can see that just using the turtle methods on euro dollar outperformed the market and had slightly less drawdown. The ES had made over double the profit, but also almost 3 times the drawdown. And keep that in mind. An individual stock like Netflix, Apple also, just give you a hint, looks very good. Google looks very good. So, these are things that you can investigate. Put the original turtle methods on a bunch of different things, right? But we used 3 different things, 3 different instruments, and they all produced more profits than the market. And 2 of the 3 had even less drawdown. The turtle methods seem to be still viable, right? What's the bottom line? Well, as you know, I am fascinated by old strategies. The longer something's been around, the longer I feel like it's going to be around. That's common sense, but that's just the way I feel with my personal trading. I would rather use a method that's been around producing profits for a long time than something that was developed last month or last year. I love long track records. I feel like I want to stand on the shoulders of geniuses and trade their methods. That makes me feel very secure. Of course, I don't want to trade anything that doesn't work, right? But we put the turtle methods with no optimizing and no changing. We put them on 3 different instruments, and they all produce more profit than just buying an index fund. And I feel like that's substantial and something that you may want to consider. And then add up on top of that, trend following's been around for hundreds of years, and the turtles have been around for almost 4 decades. This is a methodology that's been proven to be effective for a long, long time. Now, it's also important maybe to talk about some adjustments you can make, right? Who says you have to exactly do the turtle methods? You could make adjustments in direction. Like I showed you, I did a couple of stock similar instruments and I did not go short. You could use futures contracts and maybe not go long. Or you could find things that go both directions like a Forex instrument and go both directions. But that is an adjustment that you could make. You don't have to go both directions. You can make that decision, or you could choose to use both directions and only use instruments that are effective in both ways. Mess with the trade size. You know that the turtles used about 1 or 2% per trade. In my examples, I used more than that because it was just one individual instrument at a time. If you're comfortable with the drawdown and feel confident in the turtle method, you could even go higher, maybe higher than 4%. Absolutely up to you. Or go lower and trade more things. But that is something for you to think about and maybe research on your own. How about the stop loss multiplier? Turtles multiplied by 2, you could do less. You could even have a tighter stop, multiply it by 1, and just say, I'll take a lower win percentage, but I want to get out faster. I want to stop out quicker and then get back in when the trend breaks out again. So that is totally for negotiation. I have done a bunch of testing, and I've found other multiples work well. So that is something for you to look at. Or the breakout number. Obviously, the turtles talked about 20-day breakouts and 55-day breakouts. You could go even longer. I've found successful strategies for even longer than 55 in the 70s, right? So that is absolutely up to you. We know that breakouts work. We know that trend following as a concept seems to be effective over the long term. So that is another possibility for you to look into, breakout at a different number. All that being said, we looked at 3 instruments that looked pretty darn good and we didn't change a thing, right? So that is something to consider. Maybe you could just get the exact turtle methods right now and step on their shoulders and all the trading that they did and all the money that they made and just say, fine, good enough for me. I'm going to use their methods and their numbers, okay? Here's my contact information. If you have any questions about this or anything about trend following, feel free to email me. That's my email with 1 T. There's my website, my Twitter, my YouTube channel, and my blog. You can get in my weekly newsletter if you're interested. All right, that's all for now. Hopefully that's interesting to you. I love trend following, and I especially love old strategies that use trend following. And like I said, looks pretty promising. Happy trading. Good luck to you, and I'll see you next time. Bye for now.